Hey everyone, there's a concept I wanted to share that it's going to take a bit more than just a tweet. So I thought I'd bring up a chart and show you guys something that I've been following for decades, the earnings on the S&P 500 using a 4-quarter rolling, and also I'm going to show you GDP in just a second, real GDP. And there's a misconception out there that when earnings are depressed, that's a bad thing for the market. And certainly when you first roll over, that can be the case. Now, what I'm about to say is not applied to individual stocks. With individual stocks, you want the earnings growth. The bigger the earnings, the better. But when you get into the S&P 500, and when earnings start to grow across the board and earnings are growing very rapidly, the market actually does the worst. When you have 20% or greater earnings growth in the S&P 500, you're about flat on the market. And as it comes down, as you can see up here in the left, you can see as it comes down, it gets better and better. When you get down between -10 and -25%, the market grows at 26.7% per year. Now, here's the caveat. You see when it goes below 25, then you have negative return of 19%. So what it means is the market will discount it will discount a recession, but not a depression. So when you get into very depressed earnings, very depressionary periods, well, then it takes longer. And that's where we're in the situation now, where that's why we're trying to figure out if we're going to have a recession or if it's going to be a deep recession, because the market probably has not discounted all of that just yet. However, if we're not going into recession or it's mild, then probably a lot of the damage has already been done. And we've got a lot of that already discounted into the market. Now, if you take a look at real GDP, it's a similar situation. When you're above 6%, that's when the economy is growing too quickly. And then the Fed has to raise rates to cool it down. Sort of this situation we're in now, you can see we had a big spike, of course, after a very depressed level from the COVID crash. Now we've spiked and had that big surge, and now in inflation also, and that's exactly what's happening. So again, just like earnings, it's counterintuitive. Now, when you get down and you're around even negative GDP, real GDP, that's when you have your most profitable times. So again, this is the mechanism of the market where it's a discounting mechanism, and you've got to think forward, not backwards. And this is the $64,000 question: are we going to go into a deep recession or not? And I did a poll today, and I'm pretty happy with the results so far, seeing a lot of people think we're going into a long bear market or a long recession. And from a contrary standpoint, that's certainly a good thing to hear. So good luck until next time.